Hi everyone, it's Melissa with Atlas CFO. Today we're talking about working capital. Now, working capital is actually a pretty simple calculation, although sometimes it's not easy to get working capital. So our calculation for working capital is just current assets minus current liabilities. So your next question is, well, what is that? Well, what I need you to do is run a balance sheet out of your financial package, and we're going to look for the section called current assets and current liabilities. So the meat of it is what is in each of these categories. What we should expect to see in current assets are things like, our lovely cash that we love so much, accounts receivable, inventory. Well, if I gotta spell it. That was painful. And also our very favorite under-over billings. So this is our under-billing section, or our jobs that haven't had that money go into AR yet. So we'll call it under-billings. It's also called cost in excess of billings. So we want to make sure that's in our current assets. Now, current assets isn't your fixed assets. Sometimes whenever we've got something like an amortization of goodwill, those aren't in current assets. So those we don't get credit for in our working capital calculation. Our goal is to make current assets higher. So we want to make sure that we've got really good assets in there. Current assets are due or will be received within a year. Now let's move to current liabilities. So same concept, we're going to look on our balance sheet for our current liabilities, and we're going to expect to see AP and overbillings and some payroll. Just the liability section of payroll. So if we owe SUDA or our withholdings, those all are in our current section. We also have something that is pretty important, and a lot of times people miss it, and it's the current maturities. So current maturities are whatever portion of your long-term debt is actually going to be paid in the next year. So just like our current assets are what is coming to us in the next year, our current liabilities are what we're going to pay in the next year. The result of these two equals working capital. So our goal in working capital is that we have net cash left over. If we have net cash left over, that usually means we're also going to have net income, and we're going to pay any of our long-term debt. This is a real good indicator of the health of a company. So the more working capital you have, the easier it is for you to cash flow things, the easier it is for you to buy things, and the better relationship you're going to have with your banks and your sureties. Thank you so much for joining me today. If you'd like more on this topic and more about what all we offer, please check us out on atlascfo.com and sign up for our newsletter. Thanks.